Alrighty, so let's get into this. What's going on here with Honest? Well, everything has changed forever. And this stock's about to go crazy. Look at this, okay? Revenue went from $86 million to $99 million. So that was up $13 million on a year-over-year basis, right? But cost of revenue only increased $2 million. Okay. So if, technically not even $2 million, less than $2 million, right? So if your cost of revenue is only up $2 million and your revenue is up $13 million, your gross profit's going to go to the moon. And that's exactly what we saw play out here. Gross profit went to $38 million plus from $27 million in the same quarter last year, right? Selling general administrative, they actually brought that number down year over year, which is unbelievable given the fact that the revenue is increasing quite considerably, right? Marketing costs, they did increase that quite a bit, but I gotta say, they got a hell of an ROI on that. They increased marketing costs a lot. $4 million is no small amount when you're talking about a company's, this is a few $100 million market cap when it comes to Honest, right? So when you're talking about spending $13 million in one quarter on marketing, that's a lot of money. There's nothing to sneeze at, right? But they increased at about $4 million, but they brought in an additional $13 million of revenue, right? Gross profit was up $11 million plus on a year-over-year basis. So, hey, if you can increase your marketing $4 million, but you increase your gross profit over $11 million, we'll take that any day of the week. Thank you very much. Research and development, they brought that up a little bit, but not too much, right? R&D, always think about that as new products coming down the pipeline. Total operating expenses, $38 million versus $35 million, which is an increase, but it's not that much of an increase compared to gross profit, right? If we look at other income, they had a small amount of other income versus a big loss in the same quarter last year, right? So net income actually went positive for the company. And a lot of people were not expecting any sort of positive net incomes for Honest really until next year, right? We were expecting positive adjusted EBITDAs, but as far as a bottom line, like a true gap, net income positive, no one was expecting that this year. People are thinking maybe next year or maybe 2026. So the fact that we're already there in 2024 means the business is trending way better. And the management team, led by obviously Carla there, is doing way better than expected. Kate Barton and all those folks, right? So the moral of this story is Honest's business model is way better. And I mean way better than we had anticipated, right? Now, check this out. I thought this was very, very important. If you look at adjusted EBITDA here, right? So stock-based compensation, this counts as an expense, right, for the company. But it's a non-cash expense when it comes to stock-based compensation, right? They had $2.1 million of that, so they were actually more profitable than maybe it looked, right? But that also was down from $3.7 million at the same quarter last year. They had the securities litigation expense that's been some sort of issue for the company on the legal front this year, but it looks like it's likely not going to be an issue for the company next year in 2025, from at least what it sounds like. There's no guarantees there, but from at least what it sounds like, it's an issue this year, not an issue next year. So that should roll off for 2025 as well. So you have a non-cash expense there, and you have a one-offish. So their adjusted EBITDA was actually $7 million in the positive versus $1 million in the negative for the same quarter last year, right? So the moral of the story is be ready for that net income to likely increase considerably next year. I mean considerably. You're looking at a company that just is starting to get to profitability, but you should see the profitability increase be quite dramatic in 2025 and 2026 because it's going to be a multi-year play out here. Okay. Now, if you're wondering why the stock price is up so insane after it's been up so insane, it's even outperformed Palantir and NVIDIA over the last year. Here's why. A year ago, year and a half ago, let's call it that, 12, 18 months ago, there was a big debate that maybe Honest could go bankrupt. And the reason being is their losses were huge. They were running their cash balance down low, and people thought maybe they're not going to make it. And that's why that stock got all the way down to $1 a share, right? It's tough times. Carla brought herself and the team in, right? Jessica Alba left the company. And ever since then, I mean, the numbers have been nothing but extraordinary. This is one of the best turnarounds I've ever seen in my life. One of the best turnarounds. Like, if you look at where Honest's margins were at this point last year, I'm talking gross margin, I'm talking bottom line net margin. They were in the dumpster. And how fast her and the team have brought those gross margins and those net margins back is nothing short of historic. Additionally, the revenues have increased so considerably, right? I mean, we're talking about now a very nice double-digit revenue grower on the top line, which is incredible. Like, lot of people didn't think that was possible. So now we're looking at a company that's growing revenues double digits, right? And I wouldn't be surprised. Like, there's no reason for me not to believe they can't grow double digits next year, seeing what they've been putting together this year for revenue, right? We're talking about gross margins likely headed to 40% plus. 40% plus. And remember, they're in two big categories for them, or low margin businesses, relatively speaking: diapers and wipes, right? That's usually lower margin businesses. So they've got that holding them back. But my guess is that the beauty business is going to start continuing to bring up those margins as well. So we're talking about a company that's likely heading to gross margins 40 plus percent. 40 plus percent. So now the question is, where are we talking about net margins going? And that could be the next debate here, right? And so, when I look at Honest, the other thing you've got to consider is this is very, very important here, okay? Look at the balance sheet. They're now sitting on $53 million in cash and cash equivalents. So now the company has so much cash around, right? And they have no debt on the balance sheet either, right? Look at the balance sheet. It's a grade A. It's a grade A balance sheet. And it's incredible considering this is a small cap company, right? $133 million in total stockholder equity, no debt, 53 mil plus in cash and cash equivalents. Now what they could do, listen, you can still get 4% plus on treasuries. Or the 5% are pretty much gone now, but the 4% range in treasuries, you can still get that. For 2025, Carla and the team should put a good chunk of this cash into, guess what? 1-year treasuries or 6-month treasuries, right? If they do that, they're likely going to be able to make crazy other income for the company, right? This is a considerable, they could easily put, in my opinion, $25 to $35 million in treasuries. If they want to go 3-month treasuries and just have those roll over, or 2-month treasuries, whatever they want to do, right? Or if they really want to lock it in for 6 months or 12 months, they can do that. But you can get 4% plus. So run the numbers, run the math on that, right? It's not like it's a small amount of money given that Honest is a company that's still at infant stage of profitability, right? So this could make their profitability go much, much higher on a GAAP basis here, really over this next, 1 to 2 years, if they choose to do that. And if I was them, I would absolutely, it's free money. You got this money just chilling around, you're not doing anything with it, and it just keeps building. And if the company's getting to true profitability now, like, the money's just going to keep stacking. Next thing you know, they're going to be at 60 million, 70 million, 80 million, $100 million of cash and cash equivalents. Let's park a good amount of that in treasuries. Let's get that yield pouring in and talk about another level here, right? And additionally, if you're talking about another thing that took bankruptcy off the table, one is if you get to profitability, that takes it off the table. Additionally, cash and cash equivalents, 53 mil with no debt. The company's good now. They're good. They can make it through whatever storm they got to make it through, if they even have any storms to come, right? Now, if we're talking about the stock price, and does the stock price still have room to move for the upside here? The answer is absolutely. Go ahead and take a peek at trailing 12-month price to sales ratios, and this compares them versus Procter & Gamble here and Kimberly-Clark. And what you're going to see is Honest is in the 1 range, right? Procter & Gamble's in the 4 range, and Kimberly-Clark's in the low 2s. So Honest likely could easily double from here. Go from a $6 stock to a $12 stock to kind of put it in the price to sales ratio of at least kind of in the Kimberly-Clark range, right? But keep in mind, Honest has much more growth than Kimberly-Clark, so they should actually command a premium over them. So my view is the stock could easily double from here over the next year. As long as Carla and the team keeps putting up this sort of improvements and this sort of numbers, there's no reason why at this point next year, Honest couldn't be a double-digit stock, right? $10, $15 a share, somewhere in that range. And then if we're talking about that bottom line continues to increase rapidly, right, we could be talking about the price to sales ratio eventually getting to a place where Procter & Gamble is, which by that time, Honest is then a $20, $30 stock from $6 here today. So the moral of the story in regards to Honest is it's been a game-changing stock for anybody that was buying at this time last year, right? But there's still likely a lot of gains coming. This stock's likely headed to double digits, meaning $10 to $15. And then if they keep this going into 2026, the stock is likely headed then to $20 to $30 range at that point in time, right? So the moral of the story is in regards to Honest, things are looking dang good. And I'm just thankful. I'm just thankful because this looked like it could have gone bad. I've got 50,000 shares in my main private account, 50,000 shares. And then I have other smaller positions in a couple other portfolios as well. And this is one that it was looking bad, man. Go back 12, 18 months ago, it was a real maybe they aren't going to make it, right? And man, they made it. They made it, and it's becoming a lot more fun now. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management, and you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there. Celsius, big buy on Celsius here today. Huge buy. I bought 1,000 shares of Celsius. This is just under a $26,000 move here. So the moral of the story is, I believe Celsius is now officially in a bottoming out phase, and I've got to add aggressively. And that's why you see me buy 1,000 shares here today. Okay. So in regards to Celsius, I'm now up to 2,000 shares of stock. It's a $54,000 position for me so far, right? And if, by the way, if you don't know Celsius, they've gotten very popular over the last few years in the energy drink industry, but they have a little bit more of a focus on like fit, lifestyle than we can say kind of more of the Monsters or Red Bulls that were kind of more known for like the party scene, more known for, people in the workforce. Like Celsius is a little bit more for like people that go to the gym, and a lot of those sorts of folks love to drink Celsius, okay? Now, I don't know if you guys remember this video I did a month ago, buy ELF and Celsius stock and don't stop, right? But in that video, and as I've talked about Celsius the last month or two, I mentioned you guys, there's likely big tax loss harvesting coming in the stock in what I say, the fourth quarter of this year. We're in the fourth quarter of this year. And so that's why you see this continued weakness in regards to Celsius. And I told you guys, like, this stock could see $25. I think $25 is realistic. And sure enough, $25 is what we hit here today, right? And it doesn't come as a surprise at all. Listen, if you bought Celsius stock in the last 2 years, you've lost money on the stock, right? Means nothing to me. I'm the one just getting involved with the stock. Like, I don't really care. Everybody lost money in that stock over the past 2 years. Too bad, so sad. The bottom line is now's the time to get involved with the stock, at least in my view, right? And so I'm gladly picking up shares as people tax loss harvest, as investment funds tax loss harvest on this one. It was a very hot stock. The growth slowed down majorly, and everybody gets all crazy about this one, right? We're in the sucks phase in regards to our numbers right now, right? We're looking at the charts featured on 1000xstocks.com. This is a trailing 12 month. The revenue is what the revenue is right now. It sucks, right? It's down, and it's going to be down on a year-over-year basis for at least 1 to 2 more quarters before it starts to reverse and then starts going back up again, right? And we start trending back up. So we're in that sucks phase right now, which, once again, as a long-term buyer, I don't care. Like, this is a phase I want to buy in. I don't want to buy when Celsius is $100 a share like it was a few months ago and the revenue was just growing to the sky, right? Like it was back in the springtime, in the summertime. I'd much rather buy Celsius at $25 when everybody, is all, it's the end of the world in regards to Celsius stock. Now, check this out. Free cash flow, down. Operating cash flow, down. Operating income, down. Shareholder equity, up. So we do have one good thing here in regards to the short-term numbers, and that shareholder equity continues to increase. So the balance sheet's incredibly strong at this company, right? So in regards to all these metrics, we're likely 2 quarters away from starting to see all these metrics start to trend up again. Revenue, you're going to likely see free cash flow, operating cash flow 2 quarters from now, operating income, shareholder equity, all going up 2 quarters from now, okay? That's my view on this. And so, yeah, sucks. Next quarter numbers won't be great. The following quarter numbers likely will be a little less depressing. And then after that is when we start to get back to growth. And so I need to step in before we get back to that phase, because by the time we're back to the phase where Celsius is growing revenues again, growing operating income again, growing EPS again, growing the cash flows again, by the time we get to that, the stock's going to likely already made a substantial move. We could be talking about a stock by that time could already be, high 30s. It could be 40. It could even be $50 by that time. And so I need to get in front of that. And so that's why I'm picking up shares aggressively now in the 20s, right? Now, here's the deal. You got to understand, like, if people are confused, like, well, why is Celsius numbers going down short term? This is why. Basically, they did a big distribution deal, and Pepsi became a big shareholder in Celsius a few years ago. Okay, and so at first, like, Pepsi's getting them distribution everywhere, things are going great, so sales are booming like they should have been booming, right? But then Pepsi ordered way too much inventory in these particular quarters here. So these growth rates you're looking at in these particular quarters should not have been that strong. It was 104% revenue growth, 95% revenue growth, 37% revenue growth. The numbers should not have been that strong. Pepsi ordered too much, and now Pepsi's decreased their inventories massively. And from what we hear, that's just about done now at this point in time, right? And so Celsius is having to pay the price for that in this third quarter they just reported, and they're also going to have to pay the price for that in the fourth quarter as well, right? And so that's why we're in this phase right now of numbers suck. It's very depressing. And so, fourth quarter numbers, don't be excited about that. Q1 numbers also probably don't be excited about that. Q2 and beyond is when we start to see some nice numbers start to pour in once again, in my personal opinion, no pun intended, in regards to Celsius, right? And so that's what's going on there, right? And the management team's called it out. We know that now. Now, I ran some numbers in regards to Celsius, and here's why it's very attractive stock. So next year, I expect them to do about 20% revenue growth, right? Q1 numbers aren't going to be great. Q2 is going to get a little better. Q3 is going to likely be a banger quarter. They're going to come off super easy comps. And then Q4, I'm looking at great numbers as well on a year-over-year basis. So 20% revenue growth, I don't think is a stretch at all for 2025. And net income should come back very strong as those revenues start to bounce back, especially Q2, Q3, and Q4. So I'm expecting net income growth of about 40% in 2025. And then I think growth rates will slow down a little bit to a more consistent range of around 15% on average per year, and a net income growth range of around 18% per year on average, right? So if Celsius is growing 15 to 18%, right, top line, bottom line, 30 to 35 is very fair. You could even push PE to a 40 to 45 range on the stock, but I want to be a little more conservative. So 30 to 35, looking at a compound annual growth rate on the low end, 17%, on the high end, 21%, in a stock that then is, $50, $60 at that point in time. So that's why Celsius is very, very attractive. Now, if they ever get back to anything even remotely close to the old growth rates, and I'm not talking about the 100% revenue growth rates, I'm just talking about the quarters when they were growing like 30 or 23%, those sorts of numbers, right, top line, then we're going to likely see the stock go back to $100 plus by 2028, right? Which, if you can pick shares up in the 20s, and this stock is $100+ stock in 2028. It's a very, very attractive risk reward there, right? And so that's why I'm picking up shares here right now, right? But you got to understand there's a specific thing that's going on with Celsius right now that went on with Monster Energy back when it was called Hansen's Natural Beverage. So Monster product launched in 2002, right? And they launched that product. It was like double the size of Red Bull, right? This is when the energy drink industry was at its infancy. They came out with very aggressive branding and marketing, and that completely changed the business model. And so the company's stock price boomed 2002 to 2006. It was insane. The growth rates were ridiculous at this company. I'll show you in just a moment, right? But then growth rates started to slow substantially. And people got very worried about Monster's growth rates going forward. And so the stock went from around $4.30 all the way down to just over $2. And it went like there in a matter of months. What stock does that remind you of? What stock just got cut in over half in a matter of months? Oh, Celsius did. Isn't that funny, right? Isn't that funny? And keep in mind, this was way before the great financial crisis, so we can't even blame this on like the market going down. The market started to go down in the fall started in the summer of 2007, and then obviously it got ugly in 2008, 2009, the beginning of 2009, right? But the moral of the story is the stock fell by over 50% in a matter of months, right? And here's why. This was a year before Monster was launched. They grew revenues 5.5%. Then they got Monster launched in 2002, and numbers started to build a little bit, 9.4% growth. And then they really started to take off in 2003. They reached about 20% growth rate. 2004, 63% growth for Monster. 93% growth for Monster in 2005. And then things started to slow in 2006, down to 73%. Numbers started to weaken significantly. Management team got more cautious about growth going forward, right? And in 2007, they did 49% growth. growth. But the stock had already crashed, and growth investors sold the stock heavily, and value investors actually started to step up and buy monster stock, right? And so that's what we had play out there. And obviously growth rates were much lower for Monster moving forward. They went down to 49% and 14%. So growth investors said, we want no piece of this stock. Value investors begun to step in. They said, okay, you don't want this stock? We'll gladly take it off your hands. And that's exactly what's going on with Celsius right now, where the people that were in the stock because it was such a fast growing stock, 100% growth rates and 90%, those people have pieced out over the past number of months and are continuing to here into the year end with tax loss harvesting, right? And then people like myself that understand the valuation portion of Celsius that's very, very attractive over this next few years, we're stepping in now and we're starting to buy this stock. And so that's the opportunity there. Now, I did that video about a month ago. If you never got to check that one out, if you care a lot about Celsius stock, check that video out. Buy Elephant Celsius stock and don't stop. That's a video you definitely want to check out. It's a 30-minute video talking just about Elephant Celsius in that one, okay? Wasn't my most viewed video, but I can tell you that one's valuable if you care about those stocks.